The stock market is about cutting leaks. Every one of you who enters the stock market is a leak. You can cut leaks too. If you are capable, you can cut others. If you aren't, you get cut. More often than not, other people are cutting you, the leak, not you cutting others. Why do I use this analogy of cutting leaks? Let me explain. All of us voluntarily invest money into a company. Let's use Maotai Liquor Company as an example. It is listed on the stock market at 1 billion yuan. Does it have any money of its own? Remember, it's just a piece of paper. It has no money of its own. The logic of the stock market is to raise capital. So the Maotai Liquor Company comes to the stock market with a piece of paper with a price tag of 1 billion yuan to raise money. We, a bunch of fools, rush to give them money. This company takes 1 billion yuan given by others while you wait here with a piece of worthless paper that looks like it's worth 1 billion yuan. What if you want your money back? There must be a new group of fools to take the baton away from you in order for you to get your money. The new fools become the old fools. They are counting on a new batch of fools because everyone wants to make a quick buck. People wait 2 or 3 years for the new fools. Do you understand? This is the logic of the stock markets all over the world. So I advise you not to speculate in the stock market. This speaker is a well-known personality in China. He used to be the director of the Finance and Economics Committee of the National People's Congress. He said that all stockholders in the world are leeks. Cutting leaks means that bankers collect investors' money as if cutting leaks. Ordinary individual investors are like leeks growing in a field. They buy stocks, they are trapped, they are cut and harvested. After they are cut, they will buy it again. Over and over again, they lose a lot of money. So it is called cutting leaks. We don't discuss if stockholders in other parts of the world are leaks, but Chinese stockholders are undoubtedly the case. China's stock market has taken a remarkable turn recently and appears to be in a deep recession. The Wall Street Journal noted in a report on August 1, 2023, that China has about 219 million individual investors, and many of this large pool of individual investors have begun to leave the stock market, a phenomenon that has sparked widespread concern in the market. The report states that the performance of China's stock market has made many people lose confidence, resulting in the mass withdrawal of individual investors. Although stock market volatility is normal, but only to a degree, the instability and risks of the Chinese stock market over time have caused many individual investors to reevaluate their investment strategies. The report says that the inherent design of the Chinese stock market and the flaws in its system have caused the average individual investor to suffer considerable losses. Such a perception has gradually become the consensus of many investors. More and more people are beginning to realize that China's stock market isn't a safe and reliable investment option, but rather the most effective place for the powerful to cut leaks. The volatility of the stock market has put their own wealth and livelihoods at serious risk. For years, China's stock market has been widely regarded as a junk stock market among domestic and foreign investors. Many investors have deep experience in the market and believe that there are problems with its operational mechanism, which has never been resolved fundamentally. Against this background, many shareholders have been wary of the risks of the Chinese stock market. However, due to a combination of restricted information and powerful brainwashing propaganda, some people are still prone to be misled into continuing to invest in the Chinese stock market. The report also mentions that the decline of the Shenzhen-Shanghai 300 index in 2022 amounted to about 1/5 of the total value. It can be described as almost disastrous. And in 2023, despite the complete removal of epidemic restrictions, China's economy seems to have failed to make the expected recovery. The benchmark Shanghai Shenzhen 300 index has risen far less than major stock indexes in developed countries such as the US and Japan. Not only are Chinese shareholders becoming disillusioned, but the international community is also forming a negative view of the Chinese stock market.
Start your day with a healthier coffee. Day's enzyme fermented coffee is gentle on digestion, low acid, and up to 90% less caffeine than regular coffee. Expertly fermented with 50 enzymes to enhance flavor and remove bitterness. A nutty and delicious brew, roasted fresh in Middletown, New York. Order yours today.
Recent data released by Bloomberg has raised concerns about the stock markets in China and Hong Kong. According to the report, US and European long-only funds were net sellers in the Chinese and Hong Kong stock markets in July 2023. Such a trend reflects international investors' concerns about the two markets. Long-only funds, as the name suggests, focuses on buying and holding assets for the long term to achieve capital growth. Meanwhile, Morgan Stanley, a leading international investment bank, has also expressed its cautious attitude towards China's stock market, advising clients to take profits in the recent rally and end their portfolios. It has also downgraded China's rating to equal weight. Long-only funds are one of the important investors in the markets. When international investors sell long-only funds in mainland and Hong Kong, it means they are less willing to invest in these two markets. Morgan Stanley's rating adjustments indicate its more cautious view of China's stock market. Investors' concerns would lead to a flight of capital, putting pressure on the stock market. And since the ratings and recommendations of investment banks tend to have a certain impact on investors, these two events should trigger a considerable shakeup in China's stock market. The Morgan Stanley report has not only caused concern in the market, but has also annoyed Beijing. The Shanghai Securities Regulatory Commission said it would launch an on-site inspection of Morgan Stanley. The reason is it has recently initiated a double random selection process for on-site inspections of security firms under its authority, as well as the supervision of industry practitioners in anti-money laundering and the administration of investor suitability. Morgan Stanley securities happen to be selected for the inspection. So what are China's stock market's own inherent design and institutional flaws? Let's start with a stockholder's description.
The day before yesterday, the stock market was down. Yesterday it went up. This morning it went down. This afternoon it went up. Playing a share market is much more exciting than riding a roller coaster. This is what most of the shareholders feel. Look at the recent market. I think it's very distorted. This is a market that I've never encountered in my 8 years of stock trading. This market is so extreme. Either the market rises by more than 4,000 stocks a day or falls by more than 4,000 stocks a day. This kind of roller coaster market is like gambling. It doesn't reason at all.
If you are familiar with the Chinese stock market, you will find that it exhibits some characteristics. One is that it rises slowly and then falls quickly, falling within 2 or 3 days. The reason behind this is that the government and the media keep luring Chinese investors into the stock market through glossy economic theories. When the market reaches a certain high point, they will then cash out and take the individual investors' money as fast as they can. Moreover, there is a circle of people from the rich and powerful class and related organizations who have inside information, including those from China's Securities Regulatory Commission, securities firms, investment firms, etc. With the inside information and knowing how to play the game, they have made a lot of money in the past 20 years or so. The Xi Jinping administration has recently issued a call saying that the fight against corruption has entered a deep water zone, meaning that it has come to the financial sector. For example, the People's Daily published an article on August 1, 2023, with the headline, "Financial Anti-Corruption Has Reached Deep Water." For the CCP, it's usually only when something has gone terribly wrong that there is a major reform. In March 2023, the CCP government introduced a series of policies involving reforms in the financial, banking, and capital sectors. It's a sure indication that something has gone terribly wrong in these areas. In March, China's State Council announced an institutional reform package with a total of 13 major elements, 6 of which are related to finance. The China Securities Regulatory Commission is to be changed from a direct institution under the State Council to a ministry under the State Council. Branches of the People's Bank of China and the state-owned financial assets management system are to be reformed, and all employees from these organizations are to be centrally managed and included in the civil service system. Previously, China's Securities Regulatory Commission was a public institution, a relatively independent organization, as the Chinese government at the time tried to inspire confidence in investors from all walks of life. However, China's economic system is power capitalism. Under this system, the more it grows, the more deformed it becomes. The financial conglomerates created by the power elite, including the China Securities Regulatory Commission, eventually became a powerful interest group itself. It has backfired in the end. Not only does it harm the shareholders, the society, but also the Chinese Communist government. All the listed companies in the Chinese stock market, such as PetroChina, Sinopec, and giant state-owned enterprises, as well as the telecommunication companies and banks, after they have been listed, their biggest shareholders are the state-owned asset management organizations. In the total market capitalization of China's stock market, state-owned assets account for about 70%. The rest of the 30% is the market in play. In the past few years, there have been conflicting phenomena in mainland China. The private sector is wailing, while the official statistics and reports are bright and optimistic. It's actually a result of the CCP controlling public opinion. It creates the illusion of economic prosperity and concocts theories of economic brightness in order to continue harvesting leaks in the stock market. Nowadays, all sectors in China aren't allowed to complain that the national economy isn't doing well. If a civilian talks to a friend in a circle of friends on social media platforms such as WeChat about how bad the stock market is, China's Securities Regulatory Commission can call the police to arrest that person because one has commented on the stock market illegally. For example, on June 26, 2023, mainland Chinese financial writer Wu Xiaobo's Weibo account was banned, and his WeChat public page stopped updating on the 25th. Wu is known in China as the most profitable financial writer, and his Weibo account currently has close to 5 million fans. On the same day, Weibo administrators released the week's tip on creative content safety, showing that several prominent social media users have been banned for violating laws and regulations. They were banned for speculating on the unemployment rate, spreading negative and harmful information to discredit the development of the stock market, and posting content that attacks and denies existing policies and management systems. A well-known Chinese economist has said more than once that China's stock market is worse than a casino. He explained that if you're in a casino, there are several penalties if someone looks at others' cards. The dealer must maintain a fair rule. In the Chinese stock market, the government is the dealer, and there are some big clients in it, which are those security companies and funds with state-owned capital backgrounds. The Chinese characteristic dictates that state-owned assets can't lose in the stock market, which means the government has to ensure that they make money. But how? You've got to let it see some cards so these state-owned capitals can see lots and lots of other people's cards. The government sends them many messages about useful information concerning government policies. For example, in the years after 2016, when the US and China started a trade war, a lot of the big Chinese securities firms, the big funds, knew what was going on out there, but the small, ordinary people inside China didn't. As a result, they incurred big losses suddenly. Those individual stockholders were particularly shaken and puzzled as to what had happened. In March 2023, after the institutional reform, the State Council became the executive agency for state-owned asset management and the supervisory body for China's Securities Regulatory Commission. In other words, one of the largest shareholders is managing the entire market. As you can imagine, there are many conflicts of interest in this. In China, a very important bottom line is that state-owned assets cannot lose in the stock market. So, when the market tanks, who loses out? It's certainly not the major shareholders, but the individual investors in China. If it's a time when the market grows substantially in a favorable manner, then state capitals must earn a big share and leave a small portion to the individual investors perhaps. But the stock market is volatile and something may go wrong at any time, and the individual investors may be trampled under the feet of the major shareholders, becoming their stepping stones.
我今天亏了2万。
I lost 20,000 yuan or US 2,800 today. I had 210,000 in my portfolio, and today my stock dropped 10% and I lost $20,000. I don't even dare to look at my loss now. I have uninstalled the app. Originally, I wanted to make a video about challenging 200,000 yuan to speculate on stocks to 1 million yuan. The result is a direct drop of more than 10%. My goodness, I don't understand why the universe is playing tricks on me like this. I have lost more than 2,000 yuan today, and I've already refilled my position. It's a full position today, and everything is tanked. The market dropped 3,200 points.
我沪漂10年，
I've been living in Shanghai for 10 years. I've been speculating in stocks for 7 years, and have lost nearly $1 million or 140,000 USD.
幻想还能涨多少？
I've been fantasizing about how much it can go up. Why do I fantasize? Because I've been following these companies. The chairman of the board of directors said that the market value of his company's stock would reach RMB 100 billion in the future. I calculated that if the market capitalization reached 100 billion RMB, the stock price should be 30 to 40 RMB, but now it's still around 20 RMB. This is a huge profit margin, so I've been holding on to it. I think one day it will go up to 40 yuan, and I will make money when the company reaches its 100 billion yuan market capitalization. This is the long term. In the end, I got screwed. I got screwed like this, and it's a very bad situation.
今天先说到这里。
Of course, the authorities don't want the public to know these secrets. Hu Xijin, the former editor-in-chief of China's official media Global Times, has made a high-profile entry into stock speculation. On June 27, 2023, he announced on his personal Weibo that he had invested 100,000 yuan, or about US 14,000, in the stock market for the first time. He bought a total of 2 stocks and 2 mutual funds. On the first day, he made 2 gains and 2 losses, making a profit of 104.7 yuan, or about US $15 on the stock market. He explained the reason for his entering the stock market after retirement. He wrote, "In addition to wanting to have a personal sense of China's economy, I also feel that the stock market has fallen so much, and the government has said that more measures to revitalize the economy are already on the way. So I feel that entering the stock market at this time is not likely to lose money." His speculation diary profited 226.43 yuan the next day, but on the third day the entire portfolio was losing money. He lost 300 some yuan in the morning. The small honeymoon was over. Hu decided to increase his stakes to 200,000 yuan or 28,000 US dollars. He wrote, "I am not quite convinced that if I entered the stock market at this time, I would end up losing my shirt. I look forward to making a win." Netizens discuss Hu's stock speculation enthusiastically, leaving a string of comments. "I was terrified that I quickly emptied all my stocks and funds." Someone predicted, "I believe Hu entering the stock market this time is to kindle a fire in the stock market by taking the lead, to make this market burning hot, and have everyone join the market." On social media platform Weibo, topics related to hashtag Hu Xijin open stock accounts have attracted more than 93 million reads. A financial blogger posted a reminder saying while many people thought Hu entered the stock market to be a leak, based on his social influence, he might not be a leak. He could be a banker, that is, a sickle. So when Hu came out with great fanfare to tell the public that he wanted to speculate in the stock market, it's actually a very alarming thing to begin with. By early August, Chinese currency renminbi plummeted 400 points, at which point netizens noticed that Hu Xijin had suddenly stopped updating his stock speculation diary. One blogger made this comment. "I haven't seen any activity on this thread over the last few days, and I've been wondering about it. I went to his account today and found out that he's no longer there. No more updates on his stock operations, no more cheering everyone on. Now his status has changed from an active state to a semi-hidden state. He has begun his retreat, so it has sparked many rumors about the stock market. Many people think that even Hu Xijin has stopped coming out, which means that even he has stopped pretending. There is no point in even pretending anymore. In other words, no one is cheering for the stock market. If there was a breath of air before, there is none now. No one is here cheering for the stock market, so will the market deteriorate even more next?"